now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, welcome to the show. Of course, it's Wednesday, it is hump day, and we are already halfway through the last full trading week of really kind of this year so much. I mean, next week we're going to be right into the midst of the Christmas holiday break, and then right after that, ain't nobody going to be around until after New Year's. So, pretty much this is going to be the final week of real trading, and then, following the Christmas holidays, we'll get a lot of kind of inmates running the asylum as we do year-end positioning, particularly for the overall markets and year-end reporting. So again, we could see a bit of volatility between now and then, and we'll talk about that in a minute. But we're getting ready to wrap up the year. I mean, Santa Claus is right around the corner. So it was interesting yesterday. I heard a guy talking about the Christmas. He's like, "I've got a gift to give away if you can name all the reindeer." I started thinking about it. I can't remember. I get like 8 of them, right? So. And Rudolph doesn't count. Everybody knows Rudolph, but yeah, Donner and Vixen and Blitzen and yeah, all those. So that may be a trivia question this morning, is to name all the reindeer, just so I can. It's like that one in the 7 Ls. Can you name the 7 Ls? Yeah, see, there you go. I just know that I have 4 of the elves in my house, and they're mostly dumpy and gropey. So, so anyway. All right, getting back to the markets here. Yesterday we had some economic data out, and that was, shall we say, disappointing, I guess is the best case. A lot of people trying to spin the data a bit, saying, oh, it's actually not as bad as you thought. Yes, the unemployment rate went up, but, hey, we created 60,000 jobs in November. Well, net, we didn't really create any jobs because we revised down all the previous economic data. In fact, the revisions of the employment data for the entire year has been negative. And in other words, every job report has been revised lower. And so very likely this 60,000 jobs we saw in November is going to get revised lower next month when we get the December employment report. So, that's just been the trend this year. But net, you had a loss of 40,000, an increase of 60. You had basically a 20,000 job increase over the last 2 months. That's not much to really write home about. And the unemployment rate ticked up. But most importantly, if you take a look at the composition of the jobs report yesterday, 60,000 jobs were in healthcare, right? And that's not a bad thing. I mean, we all need healthcare, but those are not, in a lot of cases, these are healthcare service providers, and these are not high wage paying jobs. And as a function of that, we're seeing wages decline. Now, this was one of the anecdotes yesterday. They said, well, but real wages are rising. And that's true, right? So if you earned $1 in your income and inflation falls, which it has, your purchasing power goes up. So your real income rose, even though you didn't make any more money. That's just about the purchasing power increasing because inflation's been declining for the last year or so. So, that's, yes, it's good news that real wages are rising, but in reality, this gets down to supply and demand within the economy. And that brings us to really talking about the markets, which next year, again, as we talked about before, the analysts are expecting a 11% increase in earnings and a 12% increase in earnings for 2027 from the bottom 493 stocks. So you're expecting on average about 11.5% increase over the next 2 years in earnings of the bottom 493 stocks in an economy that's clearly slowing down, right? On multiple fronts, particularly on employment, wages, those type of things, the things that matter. Over the last 3 years, the bottom 493 have generated an average growth rate in earnings of about 2.5%. So again, you're expecting a massive jump in earnings for the bottom 493 stocks. And look, I'm not saying it can't happen, it certainly can, but it certainly seems when you take a look at the 2-year average rate of change in employment, or you take a look at the number of full-time versus part-time workers, all those are in areas that are normally coinciding with a recession, much less, at least slower economic growth, but doesn't really coincide with, a robust economic recovery. Because things change, absolutely, and, we need to be aware of that. But I just think there's a lot of risk to forecast going into next year, and I just think it's probably something we need to be a little bit paying close attention to, particularly if we're taking a lot of aggressive bets on the markets right now. So again, we'll be tracking this over the next few months. We'll keep you up to date as things go. I'll be writing articles about it as the data comes out. But again, the reports yesterday on both retail sales, which were basically at zero for this time of the year. That's not great. And the employment reports, neither one of those were just screaming strong, robust economic activity, which that's where earnings come from, right? You know, if you're not out buying stuff from Best Buy or from, Walmart or Costco, they're not making any money. So, it's great to have, share buybacks and all that, but that doesn't create a revenue at the top line. That's economic demand. So, all right, having said that, let's talk about what you need to know before the bell this morning. Like we have talked about the last couple of days, about 3-4 days ago, we talked about here on the show that, hey, it would not be surprising for the markets to come down, retest that 50, 20-day moving average convergence that we have going on. And that's what happened yesterday. Markets did sell off a tad yesterday, but recovered almost back to break even. Had a lot of buying coming in late afternoon. That's mostly institutions. And again, we're into that point of the year where they're starting to add exposure to their books for end of year reporting. But we did come down and touch that 50, 20-day moving average. And again, that's been really good, solid support here ever since this April correction. I mean, we've just consistently kind of run along the 20-day and have tested the 50-day. We had this one minor correction here of 5% that we tested the 100-day moving average. But overall, we're just in this kind of consistent trend higher. And as we've talked about just recently, we're just still within this consolidation range within the markets. After this very big run that we had, since the April lows, have just been kind of consolidating those gains. Markets are on a little bit of a sell signal right now, so we've certainly got some weakness going on that's representative of what's happening in the markets. We've also got relative strength working itself off here as well. So again, we may see a bit more weakness over the next 2 days, a little bit of sloppy trading. Again, we're just starting to try to get into this, wrap up this week. Next week's going to be very light trading, but we're getting decently oversold enough here that we're likely going to see some buying coming in. And again, this kind of sets us up for that year-end kind of Santa Claus rally, this bit of a correction here. I'd be a little bit more worried about the Santa Claus rally if the markets were just kind of like skyrocketing higher here. We're extremely overbought going into last week, but this pullback is actually probably going to be a little bit better setup for investment managers to come in and add exposure to the books for the end of the year. Again, as I stated yesterday, that does not mean that absolutely has to be the case. Again, last December was a negative return December. So again, doesn't mean, again, we talk about averages and what happens, just keep in mind there is risk to these forecasts. We're just saying that the markets are running along support right now. We've had a bit of a sell-off here. We've had some weakness here. We've worked off some relative strength. That just gives you a little bit better opportunity here for a trade within the markets here as we begin to wrap up the year. But again, this is just something that we're watching very closely here. And again, this is kind of reminiscent across multiple markets. Take a look at, this is the small cap, mid cap index. It was overbought, had just recently hit new highs. It's coming down to try to retest its moving averages. But the small mid caps are much more overbought than large caps. So again, if we start to get into the year, we may see a bit of rebalancing because of that condition within the markets between small cap, mid caps, and large caps. But specifically, take a look at this is emerging markets. This is international markets. They've been doing well. Big correction though yesterday, coming down to touch support, working off some of that recent push higher, working off some of that recent overbought condition. So again, we're seeing the same thing kind of really across markets. Has been this push towards highs, and the S&P just set a record high. Emerging markets set a record high. These stocks have all hit record highs. You're just seeing that kind of work off within that consolidation range. Same thing within emerging markets. Emerging markets had a big correction yesterday down to the 100-day moving average. Again, really the international stocks took the biggest brunt of the sell-off yesterday. The S&P is really holding up much better relative to those other kind of markets, particularly on the international and on the emerging market front. So again, that's kind of just this, again, nothing to be overly concerned about here, but again, it's worth paying attention to risk in your portfolio. So again, just don't negate managing the risk profile of your portfolio and allocating accordingly. That's what you need to know before the bell this morning. We'll come back, start our Q&A session with Danny Ratliff, taking your questions today live here on the show. Just simply go to our YouTube channel, and while you're there, be sure and like and subscribe to the channel. Certainly helps us a lot. And but yeah, you can go ask your questions, and we'll be answering them live here on the show today. We'll be right back. Get us started.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
What's the future of investing in 2026? Gain insights on how AI, technology, and the economy will shape your money in the year ahead at the RIA Economic Summit, January 17th at the Royal Sonesta Houston Galleria. Join Lance Roberts, Michael Leibowitz, and Thoughtful Money's Adam Taggart, plus top minds in AI, crypto, and retirement strategy for a powerful look at the markets of tomorrow. Seats are limited. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome to the show today. And of course, it is live Q&A Wednesday with Danny Ratliff. Danny, good morning. How are you?
Morning, doing great.
Good. I'm glad you're so chipper this morning.
Yeah, well, maybe we need to change your coffee.
I'm more, back to the Seven Dwarfs, I'm more sleepy. So.
Sleepy, grumpy. What else we got?
Yeah, dopey.
Fair enough. So
he's happy.
Anytime I get to see you, Lance, I'm happy.
Jeez.
So, hey,
Yes.
You can't name all the reindeer?
No, I can't.
You kids be
I
so
was thinking about it
disappointed.
yesterday. I haven't, and look, I'm not going to cheat and go look it up, right?
Mm-hmm.
I've been trying to remember the song that goes along with it.
Ooh.
Right? There you go.
Yeah.
Of course.
You know it, Brent?
No.
Okay.
Yeah. There's a Christmas song that names all of the reindeer.
Oh, yeah, the reindeer song. I thought you were talking about the dwarves.
No, the reindeer song.
Oh, yeah.
He got all the dwarves.
Yeah.
I mean, pretty close.
We can work our way through the doors. There's only 7 of them.
I think there's an 8th.
Most of them all work in our office.
Forgetful.
Forgetful. That's probably true. But yeah, so anyway, I'm sure somebody in chat is going to.
Oh, yeah.
Will look it up on Google for me
Yeah.
and put all the reindeer in. But anyway,
3 different languages.
exactly.
I'm looking here. I'm trying off the top of my head to remember. I'm at 4.
Hey, well, Rudolph doesn't
5 with
count.
Rudolph.
You can't count Rudolph.
So there's 8,
There's 8 reindeer.
9, including Rudolph.
Right, exactly. So you've got Donner, Blitzen, Vixen, Comet, Cupid.
Blitzen?
I already said Blitzen.
Fritzen?
No,
He's German.
he's the
Donner,
German
Vixen,
reindeer.
Dancer, Prancer.
Dancer and Prancer,
Blitzen,
yes.
Yeah.
Comet.
Cupid? No, that's something
There you
else.
go.
No. I don't know. I'm stumped.
Well, I'm missing. So I can get 7 of the 8. I'm missing 1. I just can't figure out which one I'm missing.
Bambi.
No.
All right.
So
I-
Danny killed Bambi on his last hunting trip.
I did not.
It may be where the 8th reindeer went too.
Maybe.
It's probably mounted in Danny's
reindeer's-
trophy room.
No.
Name is Venison.
Anyway, all right, let's get to work here. So in our poll chat this morning, about 60% of the votes went to talking about market risk and volatility for next year. We'll start there, and then that'll give you. Then Danny will kind of start lining up some of the questions from the chat while I'm going through this. So next year, there is a reasonable expectation for increased market risk. And when I'm talking about market risk, we're specifically talking about volatility risk, right? So as we saw this year, yes, it was a good year. We're going to be up about 16, 17% for the year, probably looks like right now. Plus dividends, as we talked about before, you're going to crank out another near 20% return year, it'll be about 18%-ish. So that's all great. But don't forget that this year we had a 20% drawdown during this year. So that's the volatility risk we're talking about. Well, that's where people make mistakes also. They sell out. They don't get back in. those type of things. Those are the things that impair returns over time for most investors. So next year, though, we're going into the year with very, very high, and I was just talking about this a second ago, very, very high earnings expectations. And here, let me just real quick, I can grab a chart that I was just posting a couple of these things out this morning on X, because, this is kind of some of the things that, I'm starting to look at right now as we go into next year. And as we do that, this is where I'm starting to look at valuations and these different types of structures. But, if you take a look at valuations as a function, every virtual measure of valuations are at more of their extremes, with the exception of implied earnings growth. Implied earnings growth is at the top end of its. So this is 1, 2, 3, and 4 standard deviations of the long-term averages of these items going back to 1900. The only one that is at the top of just one standard deviation in terms of its long-term average is implied earnings growth. Everything else is trading at 2 and 3 standard deviations, and the diamonds are the current values, and the little bars are the min-max, right? So we're trading in most situations, trailing PE, forward PE, trend PE, Cape Shiller, we're all trading near the upper ranges of historical norms. Now, that does not mean the markets are going to crash. All this tells you is that bullish sentiment on equities is very high. Everybody's willing to overpay for equities. Why not? Markets don't go down. And if they do go down, they come roaring right back, right? So there's no risk. So as a function of that, we're willing to overpay for stuff. But this is what valuations mean in reality, which is that I'm willing to overpay for stuff today because Wall Street is telling me that over the next year or so, we're going to have some outstanding earnings growth. And I need this chart, Brent, please. This is what I was talking about a little bit a moment ago at the beginning of our show, is that if you take a look at projections for next year, the largest top 7 stocks are expected to only grow earnings at about 18% in 2027, 23% growth, which is about the same as they did this year. So not much change going into 2025 from the Mag 7. But pay attention to what's happening with the bottom 493. You went from -3 to 5 to 7% growth in 2025. Now, again, that's where you get about on an average, they were growing earnings at about 2% a year, 2.5% a year over the last 3 years. And that was during booming economic growth. We had very, very strong economic activity. Employment growth was rising. We were recovering from the pandemic, all of that stuff, right? We had the decline in 2022. So we had this big recovery in 2023, 2024, 2025, and yet they were only growing earnings at an average rate of about 2.5% during that period. Now, over the next 2 years, we're now expecting 11% average growth in an environment where the economy is slowing. And more importantly, now I'm going to show you one more chart. This is a chart from my buddy Albert Edwards at SocGen. This is whole economy profit margins for corporations. And that had surged, obviously, when we shut down the economy and stimulated the economy with all kinds of, capital investment, sending checks to households, et cetera. We had this massive surge in profitability, right? That's now appeared to have peaked. So now, in other words, profit margins are going to come under pressure. And as you have slowing economic growth, that's going to weigh on revenue, which is what generates the profit margin at the end of the day. Supply and demand. So the big thing to watch for next year is, and again, so now let's take this back to valuations for a moment. I'm willing to overpay for valuations today because I'm not worried about it. Right now, everybody's telling me that earnings are going to be booming next year. Maybe they will. But if they don't, and there is a revision to those earnings growth, I now have to reassess my valuation I'm willing to pay. So that's the market risk going into next year. It's not potentially some, economic, disaster or whatever. It's simply a function that something happens economically and the economy doesn't come roaring back next year. And all of a sudden, Wall Street needs to begin reassessing what they expect on earnings. And since earnings is the function of PE, right, is price divided by earnings, if the earnings goes down, I'm going to have to adjust the price, and I'll have to adjust the price lower just to maintain the current valuation level, not even talking about a valuation reversion. So that's the key risk for next year. Does that mean the market's, crash? No, it doesn't mean that at all. But I'll give you a chart from one of the most bullish guys out on Wall Street, which is Tom Lee from Fundstrat. Tom Lee from Fundstrat posted this chart today. He expects that, yesterday, but this is a historical composite, and he thinks that gains will be back-ended in 2026. In other words, we'll have a decent rally at the beginning of the year, give it all back up again, just as we did this year, and then a rally into year-end next year for a 12% return. Now, again, this is the most bullish guy on Wall Street all the time. He is always perma-bullish. But even he is starting to worry from a standpoint, when you start taking a look at valuations, historical measures, all those type of things, it is hard to see how you have a fourth year of gains without an increased pickup in volatility. So there's the answer to your question. Danny, let's get to the questions.
All right. Actually got one last night. It was pretty good. Wanted to address today. So said, curious if you know how the new bill will affect donations to donor-advised funds or itemization for charitable gifts. Read several internet articles, but it is not clear at all. And it's not. There's a lot of moving parts with this. So one big, beautiful bill made some changes here in 2026. So if you itemize, now stats out there, since we're doing heavy on stats this morning, that 86% of people are actually going to take the standard deduction, which makes sense considering it's pretty darn high. It's gone way up, right? Individuals, it's $15,750 or $31,500 this year. Next year, it goes up a tad to $16,100 for an individual or $32,200. So a couple changes coming with that. Now, you're going to be able to take the standard deduction and either take $1,000 or $2,000 itemization, essentially, if you give those proceeds or funds directly to a charity. Now, here's what is getting most people, why you may be inclined to go ahead and take or make that charitable contribution in 2025 versus 2026. So in 2026, a new rule is going to come out that's going to essentially state that you are only going to be able to write off, if you're itemizing, your donation above 0.05% of your AGI. So if you make $100,000, you make a $1,000 donation, which in this case really wouldn't matter, but let's say you make a $20,000 donation. You're only going to be able to write off $19,500. So just for easy math, that's $500. So anything above there, you're going to have to essentially, at that point, that is what your itemization is going to be for your deduction. So if you're looking to go ahead and say, well, I'm not donating as much, or I want to get as much bang for my buck, 2025 may be a bit of a better year versus 2026. Also, if you are a high income earner, they're going to cap you at 35 cents on the dollar, essentially. So you're going to have a cap up to the 35% tax rate. So if you're in the top bracket at 37, you're only going to be able to utilize up to 35. So get a little bit of a haircut there as well. So small nuances. There are some advantages if you are taking a standard deduction. You still want to give a gift. Do keep in mind that cannot go to a donor-advised fund. It has to go directly to a 501c3 to get that additional $1,000 or $2,000 deduction. But certainly something to be mindful of in your year-end planning. So if you have not done that as of yet, you may want to run the numbers, see what that looks like for next year. Many people are doing bundling, so putting additional funds, all at once into a donor-advised fund. So let's say you want to give $5,000 a year to a charity, but you had a really high income year this year. So some people may be inclined to go ahead and say, you know what, I'm going to donate $25,000 just to get that extra additional deduction. And really the math that you'd have to do more than that just because it's where standard is. But then you make that actual contribution each year, but you get the tax write-off this year. So things to consider. But that was question number one. So Lance, let's kind of jump into, what is the big difference and what are you seeing with buybacks versus increasing dividends? You touched on it a little bit.
Well, increasing dividends, the problem with that is that
basically removes capital from the company, right?
Yep.
Because I've got to pay that out, which is fine. And it's great if you want to have long-term returns in your portfolio that exceed growth, buy dividend stocks, right? Because over time, and again, long periods, we're just talking about decades. Over decades, dividend value has outperformed growth over time, right? Lower volatility, plus you get the income. So but for companies today, it's more efficient to manage earnings since we have a whole market driven on earnings expectations. Like, did you beat the expectations? Did you beat the earnings? It's easier to navigate that by doing buybacks. And then also, too, all buybacks are primarily used by insiders of corporation to cash out value. Correct. So so yes, if the question is what do we see, kind of moving into next year? Yeah, more buybacks and dividends will get increased by companies that are regular dividend growers. But the companies that are heavy buyback achievers, they are going to continue to increase buybacks.
Well, you touched on something. Really, it's the incentive. They're incentivized to buy back stock because it keeps that demand up, keeps prices elevated, and essentially, that's where the majority of C-suite executives are getting paid. Their salaries are decent, but they're not like they used to be back in the 90s. Clinton made that big change, which therefore they found the loophole, and which is why buybacks are so popular, because they can go buy back stock. It increases the shares they own. It's kind of a little bit convoluted, but certainly probably a big function of why. So what do you envision for rates after Powell?
Yeah, I've got a whole list. You're missing a few. Let's go back to the top of the list. I've been over here while you were talking about whatever you were talking about.
Well, these are the top of the list. But yes.
Gold and silver next year. What do you expect? I've got an article coming out talking about margin debt. There is an extremely high correlation, and it's not surprising, between price increases and margin debt, right? Because you're buying things on leverage. So if I can use leverage to buy things, then that increases the overall rate of what I can buy. So it increases demand, so prices go up. What drives the price of gold and silver and stocks and Bitcoin and, at the end of the day, everything else? Is it a narrative or is it supply and demand? It's supply and demand. So if there's more buyers than sellers, the price goes up. That's why markets go up in price. Markets will go up more if I can create more demand for those shares by doing it on leverage. So it is not surprising there's an extremely high correlation between margin debt levels and the rate of change in margin debt versus gold, versus silver, versus stocks, versus Bitcoin. Very high correlation. So if this is the big risk next year. So this is if you did not read this past weekend's newsletter, we didn't get to have a show on Monday, and so Monday's show was called the Double Bubble. The Bank of International Settlements just did a really big report on gold and gold and stocks, and historically over the last 50 years, this should not be of any surprise to anyone listening to the show, is that when you have asset classes have a correlation of 1, when something happens that causes a reversal in one of those correlated assets, they all go down at the same time. And so next year, your big risk, particularly when you're looking at things like silver and gold, which are extremely overbought, extremely deviated from long-term means on a monthly, when you're talking about monthly data, right? We're not talking about daily trading, but when you're looking at long-term trends, when you look at monthly price deviations from long-term means at the levels you're seeing in gold and particularly silver, but also stocks, the risk of reversion is much higher. And so that risk of reversion is magnified if you also get a liquidation event that occurs that reduces margin debt, because now I've got to sell more to cover my margin. So again, if you didn't get a chance this weekend, this report by the Bank of International Settlements that we covered in the newsletter, let me see if I can just grab one of the charts from them real fast, is a good read. And because again, look, we're long gold and silver in our all-weather model. We've taken some profits recently, but we're still very long those metals. We're also owning uranium. We also own other stuff as well, which have done exceptionally well this year. That portfolio is doing fantastic. But the risk is, as with all assets, is of reversion. Narratives are just the rationalization for why something's doing something, either going up. If it's going up, we come up with a rationalization why it's going up. It's debasement, it's whatever. If it's going down, we come up with a rationalization for why it's declining. But at the end of the day, just remember what drives price, and particularly on an asset like commodities or silver in general, gold in general, it is all supply and demand, and it's all traded on futures. So this is all of what's happening on the CME at the end of the day. So if anything occurs that causes a reversal of expectations, you're going to have a correction. And this was one of the charts that we showed. So this was a chart that we put in a newsletter this weekend. And this was a note from the Bureau of International Settlements that said, for the first time in over 50 years, both gold and equities have shown similar explosive behavior. And here's the chart that you can see is this is exactly diamond. So this is stocks versus gold. And you can see that since 2014, they were traveling in kind of a rising trend line. And then since 2020, the October bottom in 2022, everything has just exploded higher. And that's okay, right? There's nothing wrong with that. It's been great. It's been a great ride. Everybody's making a lot of money. It's awesome. Just be aware of that underlying risk that eventually you are going to get some type of reversal that causes things. Oh, I did publish these charts. Sorry, I didn't realize that. I knew I was going to publish these, and I published them. I write so much stuff, I forget where I publish stuff. This is in last weekend's newsletter, but this is a chart of margin debt. This is the annual rate of change in margin debt versus the S&P 500. So what you can see is there's this is the chart on the left, margin debt versus the S&P 500, very, very high correlation. Margin debt versus the annual rate of change in silver on the right, very high correlation. And then we also see the same thing, Brandon, I'm going to change one more chart. We see the same thing in, obviously, gold prices. And so you just went to a different graphic. There you go. This is brought to you by our advisors. You also see the same correlation between margin debt and gold. So again, the thing to be paying attention to, whatever your expectations are for next year for commodities, gold, silver, stocks, Bitcoin, it doesn't matter the asset class. If it has a correlation of 1, pay attention to margin debt. That's going to be, and we're not talking about the level of margin debt. We're talking about the rate of change in margin debt. If the rate of change in margin debt begins to reverse, that's going to be problematic for all risk assets. So kind of going back to that fund strat post that I showed you on X a minute ago, kind of that mean reversion during the course of 2026, that would likely be across all asset classes at one time. So again, that's just from a risk management standpoint, that's what you want to be careful of in 2026. Again, does that have to happen? Absolutely not. I'm just saying if you pay attention to the rate of change in margin debt, it can help you navigate risk assets. And these are all, stocks, gold, silver, platinum, all these type of things that are going on with precious metals. That's just a chase to get exposure, and that supply-demand imbalance is what's driving the prices. So if anything happens that reverses that demand, you're going to get a correction, and that'll be the thing to be paying attention to. So anyway, good question, though. Sharp's Law says he has no interest in crypto, so he's not coming to the summit this year. If you haven't gotten your ticket to the summit, be sure and get it now because tickets are going fast. And Sharps, we love you, man. You're awesome. I love meeting you at the summit and visiting with you. But we have more than just crypto going on at Summit. It's just one guy talking about crypto. You can step out and go get some coffee and a donut, whatever we're serving for breakfast or brunch while he's talking. But yeah, we've got Brian Dunlap from BlackRock. He's talking about AI and what's happening in the crypto space, not the crypto space, sorry, the artificial intelligence space next year. Infrastructure as well. That's going to be all the data center build out, what to expect. Ed Slott covering everything about financial planning. He's much more entertaining than Danny and Richard. So, you'll certainly want to be there. Then, of course, Michael Leibowitz on fixed income expectations for next year under the new Fed chair. And then, of course, I'll be covering the markets, economics, everything else. So, again, and Adam Tagg will be there as well. So, Sharps, if you don't come, shame on you. There's a lot more going on than just crypto. Anyway, but make sure you get your tickets. They are going pretty quick, and we are going to fill up pretty quick because sales are going well right now. So, again, get your tickets. They're online. Just go to realinvestmentadvice.com. TLT shorts at 26% of float. Yes, TLT has a huge short position against it because that's how people make money. And you have to remember when you're paying attention to shorts, there's two things that go on with short positions. One, shorts are a speculative bet. As long as I can force the price move in a direction, if I'm Wall Street, if I can heavily short something and move the price, I'm going to do that. And bond traders, and particularly hedge funds, et cetera, have had a big short position on treasuries for the last couple of years because they can move the price. And by shorting it, they can aggressively move the price of TLT because of its float, of its overall float that's sitting out there. So they have control of the game momentarily. They don't know anything. They are simply trading what they can control, and they're simply trading the price. In a lot of cases, you also have to remember that shorting is a hedge against another asset. So if I'm, just as an example, if I'm a hedge fund and I want to be long gold, or say long stocks, I can short treasuries and I can hedge that trade. So if something goes wrong, I get a reversal and I'm hedged in one of the two positions. So again, always remember about shorting is that on Wall Street, it's a function of price control. It's also a function of hedging and arbitrage. And there's a lot of arbitrage that's going on right now in the markets. They don't know anything. They don't care about anything other than what's happening with the price right now. They don't know anything. They're not betting on a future outcome. They're simply trading what the price is doing right now. They're taking advantage of that. And this is the same thing that's happening in gold. Reason you're seeing silver go up. It's people chasing that asset right now because it's going up. And if I can make money on it, then I'm going to chase it and I can make money. I can make money because it goes up. But don't forget, they're a lot smarter than you. And when the price reverses, they're also going to have the reversal in the price. And they'll heavily short the commodities, the market, whatever it is. They'll arb the other side of that trade when it begins to happen. And you'll be sitting there kind of figuring out, like, oh my gosh, why is everything going down? They're going to be way ahead of you on that game. So it's really good to pay attention to, there's what's called the Commitment of Traders Report. And in that Commitment of Traders Report, you can see everything that traders are doing in terms of futures on the Russell 2000, the dollar, the S&P, whatever, how long they are and how short they are. And that gives you a lot of insight about where they're positioning and then what the next rotation is likely going to be, because these things ebb and flow constantly. So they don't know anything. They're simply taking advantage of a price trend right now. And so, you can trade with them for sure. Just make sure that you also trade with them in the other direction as well. Best portfolio allocation for 2026 still continues to probably be, predominantly equities next year for now. So, if you're kind of long equities at the moment, that'll probably continue to be a better allocation for next year rather than being, heavily weighted in fixed income. We're likely, with economic growth slowing next year and with inflation slowing, and interest rates are going to kind of be stuck where they are for the most part, somewhere between say 3.5% and say 4.2%, somewhere in there. We'll probably be stuck in this range for another year. So you're going to collect the income from your fixed income, which will be 4%-ish next year. So that's not terrible. But again, if you built a portfolio next year that was predominantly weighted in dividend yielding equities, and you have a pickup in volatility, that type of structure will likely play out a lot better for you. So again, just we're not going around. We don't change allocations based on a year, right? So if we're running a 60-40 allocation, that's what we're going to be managing next year. If we have an 80-20, 70-30, 90-10, 100% stocks, all weather, all these different portfolio models that we run, we don't change those allocations, based on what expectations are next year. We just manage those allocations through the year. But again, if you're switching your entire allocations on a year-to-year basis, I would probably be overweight more defensive dividend-yielding stocks next year to hedge volatility risk.
Well, but hang on. It almost sounds like you're talking about a static model, whereas our models will, like, for instance, they're overweight at the moment, where there'll also be more defensive in times when we need to.
Right.
So we could have very little equity exposure in any of those models if we need to hide out in the bunker. And now we have the wind at our back. We may get a tad bit more aggressive, but within some guardrails, so to speak.
Yeah. No, absolutely.
Yeah.
Absolutely. Here's a good question for you, Danny. What investment should not be held in a Roth IRA?
Ooh, this is a great question. So in general, we want to think about tax efficiency. Now, the IRS is going to have a handful of things that you cannot or should not hold inside of that Roth IRA or IRAs in general, like S corporations, collectibles. You may not want to hold penny stocks. And then depending on what or how you want to use real estate, you want to be mindful if you're getting something that's going to be depreciated quite a bit. Do you actually want that in the Roth IRA? Now, you may have high expectations for future growth. Great. However, if you're looking at it, which most people are, they want that depreciation. From a tax perspective, may not be the best idea to hold all types of real estate or business investments inside of that IRA. Outside of that, you may want to be cautious of a company that may have IBDs, things of that nature that you want to capitalize on. And at the end of the day, make sure that you can take full deductions. So the Roth IRA, albeit I really love, right? I'd love to be able to have most assets inside of it because you get that tax-free growth. We're not worried about capital gains, not worried about any interest or dividends from a taxation perspective. And when you take the funds out, unlike the traditional IRA, we're not paying ordinary income taxes on it. You can make an argument it's actually better than even taxable funds for the most part. But if you're utilizing these and trying to get very strategic from a tax perspective, there may be some areas or some positions where you would not want to hold inside of that.
That's right. And again, say anything that, again, this is IRAs as well.
Yeah.
You don't put real estate inside of an IRA. You lose all your tax deductions for owning real estate. But I see this a lot with people doing that.
Oh, in fact, yeah. I mean, I can tell you we have a lot of clients who have in the past done, multifamily investments, other types inside of traditional IRAs. And like, oh man, why did I do this? Because, when they go back to refinance this, you're not getting the most bang for your buck out of it, plus the deductions along the way. So most of those clients we visit with, they've been like, man, I wish I would have never done that inside of that IRA account. So in general, we typically advise not to. But yeah, it's a great question.
Yeah. Another one is talking a little bit about MACD, RSI over volume. We had a good question about that, is that, volume is fine. Volume tells you a lot about supply and demand, and we use volume. Right, but and again, you'll notice that we talk about money flows from time to time in our morning bell. In fact, the chart I was showing you this morning, there was that kind of graph behind, which is money flows, which is also tracking volume. Right, it's you have more buying volume or more selling volume, and that's a function of price movement. So yes, volume's important, and RSI is not a be-all, end-all indicator. There's a comment that RSI is not useful. It is very useful. But because it does tell you when stocks are very overbought, but it doesn't mean that stocks can't be overbought longer than you expect. It's just a good indicator that you're getting to much more overbought extremes on certain cases. But again, you have to combine that. That's why we look at things like Bollinger Band deviation. We look at the MACD for momentum. We look at a lot of different structures. Just because I kind of keep it basic in the mornings here on the show doesn't mean that those are the only indicators that we're using, but that's how we navigate markets over time. That's how we know to get out of markets. Like back in March, we were reducing exposure before the sell-off because RSI was extremely overbought. MACD was turning lower. You had all these kind of indicators that were setting up, and over the years, we've been, have said, hey, markets are really overbought, take some profits, and we have a correction. Doesn't mean it happens next day or next week or next month. Comment about, last year I said sell gold, and then you had a big correction in gold, and then we talked about, hey, there's a buying opportunity for gold. So those, don't take statements out of context and don't take an indicator out of perspective. They are just a tool within the toolbox, and it doesn't mean that they're not useful. All the tools are useful, and whatever, we did a whole show on technical analysis previously, and it's like, technical analysis is very personal. Everybody does it differently. Everybody measures things differently. There's no right way or wrong way. And just because you disagree with a particular indicator, fine, go find a different one. There's a lot of indicators. I know I'm not a big fan of Elliott Wave. A lot of people are. And, the reason I don't like Elliott Wave is because it just, you have this revision problem. And you say, well, it's an ABC wave, and then something else happens. You go, oh, well, it was actually an ABCDE wave, right? Or whatever it is, right? So you kind of go back in history and change the analysis. And I don't like that. I like saying, this is what it was, this is what we said, and this is where we were right or wrong, about this particular trade. So again, that's how you do technical analysis is up to you. We keep it really basic here in the mornings just to keep it from being confusing. But, if you actually get into our technical analysis about the way we do it in our shop, it's a much more complicated process. But again, it's just stuff that you'd be sitting here watching a YouTube channel in the morning going, I have no idea what he's talking about. So, we just try to keep it really basic. But again, that's just for ease of understanding in the morning, of just understanding risk, right? How much risk profile is there in the markets right now? Is there risk to your capital? And it doesn't mean that risk to that capital matures today or tomorrow or even next week. It just says that risk is building. That's all it's telling you. And, so just something to be mindful of. Danny?
So another question here was, somebody is 55. I'll say somebody. Hold on, I'll tell you exactly who. So Joette says, I'm 55, plan on retiring at 63. I'm 100% C funds, so in a thrift savings plan. It's your opinion, is that where I should be? Well, that depends. I think there's a lot of moving parts here that need to be taken into consideration. So what are your other assets? What are your expenses? When do you intend on utilizing these funds? Also, what does your pension look like? So really, we need to break it down and look at a plan. So, when we start to determine and factor in all these other questions, and then we can say, okay, well, here's an inventory of assets. Here's what you have. If you're looking at your 55, looking to retire at 63, you have an 8-year window. You're likely going to be able to take some volatility. But if that is all you have, and you don't have savings outside or investments outside, then maybe we want to revisit what that allocation looks like. Now, within thrift savings plans, options are fairly limited, but it's not a bad thing either in some ways, because you can say, hey, I've got these 5 different options. Here's what I should be utilizing. Here's maybe a little bit of cash on hand, maybe a little bit of fixed income, but really tough to give an answer to that without knowing the full story.
That's right. And again, and this is why, sitting down, having, building a financial plan, those type of things are always very important, because it helps define those things a lot.
Correct.
better.
Well, it'll give us that roadmap to the allocation, to what type of risk you're comfortable with. That C fund's done great. Markets have done very well this year. How are you going to feel if it doesn't do well? Number one, how will that derail you? So thinking about sequence of return risk and math of loss, the closer you get to retirement and you get to that distribution phase, the more important that is. And so this may be where over time you do begin to get a little bit more conservative, but also if you're sitting on a ton of cash or a healthy investment account on the side, that may not be a big factor at the moment. You may say, hey, I'm going to roll these funds over at 63. I'm going to be looking to do Roth conversions at some point in the future. I have other assets I'm going to live on, my pension / Social Security. Not a big deal. Well, then, yeah, you may be able to be a little bit more aggressive. But if that is the only assets you have, it may be time to revisit that and take that in consideration, what other options you have.
Right.
But yeah, plan will certainly dictate that.
Yeah. And again, this is kind of part and parcel for just, a lot of y'all in the chat are way too serious about stuff. And what I mean by that is that you take, things that, we're looking at and saying, look, there's risk here. And you're like, okay, I don't see that. And so it can't be right. And these things happen. Nobody knows what the future is going to hold. Right. And so this is why, just understanding, looking at both sides of the coin. Again, y'all tend to take things out of context. Like if I say gold is overbought, you go, well, they don't own any gold. That's not true. We own gold and silver and platinum and uranium in our portfolio. We have a portfolio that runs precious metals. Just because we say it's overbought doesn't mean that we're selling everything. This is the problem with the media, is that you're assuming a binary outcome of every conversation. All we're talking about is risk. Is there more risk than not? Somebody made a comment that gold isn't overbought. Here's a chart. You tell me if gold or not is overbought right now. This is a monthly chart going back 50 years. There's only been 5 times in history that gold has been this overbought, and we're trading at four standard deviations above the 4-year moving average on gold. So you tell me, is gold overbought or not, right? And we can do the same thing. We can throw up silver, and I'm not going to change any of the metrics. I don't think silver goes back 50 years on this chart. I don't think I have 50 years worth of data. Yeah, there you go. You tell me, is silver overbought? and what has happened previously when you've had these type of conditions previously in silver. Now, whether or not you want to admit that or ignore the potential risk of a reversion, which has happened every single time, that's up to you. And these charts, when you have these big move, it obscures some of those other charts, or some of the other corrections, but most of those corrections are 30-40% in value. And then you went through a fairly long period of time where it did nothing. So again, whether or not you agree with us is irrelevant. I'm going to end the show today and I'm going to go do my job, right? Well, your opinion means, I appreciate your opinion. I appreciate your outlooks and your views. But if you choose to ignore what I'm telling you, that's okay. That's the risk that you take, right? And all we're talking about is, hey, be aware of the risk in your portfolio, manage the risk. We want you to have a positive outcome over the long term, right? We don't want to see you have major reversions of capital, which happen consistently throughout history. That's it. So, I mean, if you agree with us, great. If you don't agree with us, don't watch the show. There's plenty of other stuff to go watch on YouTube. I'm sure there's probably monkeys dancing around dogs right now somewhere on YouTube you can go watch, or, people petting cats, whatever. I'm sure you can go look up a YouTube that'll name all 8 reindeer. So, leave here, please, and just go find something else to do. I don't need you trolling in the chat. And by the way, if you troll in the chat, I'm going to ban you. So, it's just we ban people every day in the chat. So if you troll and et cetera, we're going to ban you at some point. So, especially if you're disruptive to the community, because we value our chat community. And we want good, intelligent conversation in our community. We want, and that's sometimes hard to come by, but but we value our community. So if you invade our community and start trolling, we're going to ban you. So
just be cool. Bottom line.
Yeah, just be an adult. Oh, it's hard. Sectors and stocks for next year. That's going to be the big question. And again, we talked earlier about potential for volatility risk next year. Again, making predictions are a fool's game. And, when people come out and say, oh, next year it's going to hands down be this or that, odds are pretty high they're going to be wrong. That's just the way markets operate. However, statistically speaking, and just fundamentally speaking, going into next year, and this is why we've started making some minor adjustments to our portfolio recently, adding in some more dividend yield, a little bit more defense into the portfolio. I think that next year, if we have slower economic growth, if we see a reversal in earnings expectations, I'm not talking about a collapse in earnings expectations. I'm just talking about going from, say, $330 in earnings next year to $300 or $290. If you have a negative revision in earnings, and analysts are always too optimistic, right? So they're always going to get revised lower. If that occurs, then growth stocks are likely going to come under pressure. Now, it doesn't mean that they have a bad year. It just means that maybe there's more volatility and they don't rise as much. I think that next year, having an allocation to some defense in your portfolio, so think about staples, utilities, real estate, those type of things, could pay to have a little bit of volatility protection in your risk. Now, again, I'm not saying go sell your gold, go sell your growth stocks, go sell your NVIDIAs. I'm not saying that at all. We're still probably going to own those companies unless something, goes wrong. But you want to kind of pair that risk exposure because of the correlations that you've got in those stocks and those asset classes in general. That's a near one correlation. You want to kind of pair that with some stuff that is not correlated. It doesn't have the same correlation, because if there's a rotation in risk, it's going to move to a risk off position, and those are the stocks and sectors that should perform well. Interest rates will be lower. If the Fed comes in, starts cutting rates, and again with this change potentially to Kevin Hassett or Kevin Warsh, and right now Warsh is in the lead. That's going to probably promote, there's going to be further rate cuts next year, maybe not aggressive rate cuts, but again, we see 2 or 3 more rate cuts next year. That's going to bring down the short end of the curve. If the economy slows, and that's what employment's telling us, the long end of the curve is going to come down. And so that's gonna feed into that defensive nature, right? So real estate should perform better next year. It's had a tough year because of rates. If rates come down a bit next year, we're going to see a little bit better performance in things that are affected by lower yields. So think utilities, think real estate, those type of things. Utilities should also benefit from the data center build out, electricity demand. Utilities should perform better. So again, there's some reasons to think about a little bit more. And again, I'm not talking about switching your whole portfolio to defense next year. There's no evidence of that. But maybe starting to add a little bit of base in, a little bit of structural support. This is what a good hedge fund does. A good hedge fund just manages risk, right? So they've got a lot of growth exposure, then they go arb that out through some other type of asset, right? They'll go short treasuries or short, whatever it is, to arb out any risk that they've got on the other side of their portfolio. That's called hedging. So that's why hedge funds do well and they're successful over time, and that's why they have a lot of capital, because that's how performance rules. So think about your portfolio kind of like a little mini hedge fund, and just think about adding some arbitrage, risk management in your portfolio by just thinking a little bit, kind of ahead of the game of what the risk might be next year. So, Danny?
So another question was, wife has a 403B and also has the ability to contribute to a 457. So typically that'd be a government employee or a teacher. What plan should be invested in, or should you do both? And if you can do both, if you're maxing out the 403B, that 457 can be a nice feather in your cap if you're looking to defer more income for the moment, right? You want to put pre-tax funds into an account, pay taxes on them later. Biggest differentiator is going to be, especially long-term, and some of you may have one versus the other, but that 457 is not going to have any 10% penalty for withdrawals before 59.5. Sometimes, depending if it's deferred comp, you may actually realize or recognize that income as it comes in. But for the most part, the plan's contribution limits are the same. There is a 15-year of service contribution, like catch-up, that you can do in that 403B, which is an additional $3,000 a year or up to $15,000. So if you can utilize both, great. I would start looking at how do you hedge yourself against potential future taxes. So we don't want all of our funds inside of that pre-tax. You can do something that has that Roth element to it. That may be a nice way to kind of diversify from a tax perspective. So diversifying registrations, accounts is something you should certainly be entertaining. What we don't want is to get in retirement and have every single dollar you have in that one bucket and basically fully taxable upon distribution, and then also dictated by Uncle Sam as far as when and how much you must take each year. So start thinking, especially if you're younger, or you can go ahead and start diversifying the assets, not just, we're not talking about stocks and bonds. We're talking about the taxation of them. I think that is crucial to give yourself a leg up in the future for what we may or may not know.
Yeah, exactly. And last question, we'll wrap up the show after this one, is got a good question here about energy plays next year. And there's some energy plays, like, for instance, in our portfolio, we're long Kinder Morgan Energy, GE Vernova, AES, AEP, and Duke, right? So we in 2 different portfolios, we own different energy stocks, but so we own some utility, some energy in both portfolios. The thing I'd be careful of is there's a lot of speculative trading going on in companies like Oklo. The problem with Oklo is that they have absolutely no sales, right? It's all a bet on a future outcome. And there's so many things that can happen between now and if and when they ever get start generating some revenue. And again, they will at some point. I'm not sure why they're public at this point, considering they have no revenue. But it's kind of like a stock should be public when you have revenue. But again, it's a good speculative trade. So if you want to spec on Nuke, that's fine. Just that stock just had a 50% correction. So there is a lot of risk in companies like Oklo that have no actual revenue at this point. Conversely, if you want to play nuclear, buy NRG or Constellation Energy Group, GE Vernova, that have revenues, I think is a little bit safer play. And so if you're kind of looking into next year, I think there's two places you want to kind of focus on. One is on the utility provider side, because they've got to deliver the utilities have to deliver the power to the data centers. Electricity prices are going up. That's going to be good for utilities next year. And the more demand that we have for AI data centers is going to be increased demand on the electric grid that we don't have in place right now. The electric grid is just not in place to deliver that kind of power generation. So on the other side of that, think about natural gas pipelines, because these, as we talked about before, the data centers are going to have to connect to the natural gas pipelines. We wrote an article on the website talk about behind the meter. So if you just Google behind the meter on our website, you'll see the article, but talking about how these data centers are going to have to attach to pipelines in order to generate electricity for the data center until the grid is built. So I think there's really kind of two plays for next year. Bloom Energy is another one. But you've got to be careful with that one. It's like way ahead of its fundamentals. So just again, I think fundamentals are going to apply at some point next year. But I think you definitely need, to your point, I think you definitely need to have some exposure to that area, because the data centers they're coming. As I talked about before, my wife is currently working with data centers right now to provide LNG, to provide a temporary power solution until they get onto the pipeline. So there's all these kind of layers that are in there, and you just need to be kind of aware of that. So. But I think it's a good idea. All right. We weren't way long today. So thanks for all the questions. They were great questions today. We'll do this again next week as we continue to kind of unravel markets as we get ready to wrap up the year. Be sure to go by the website, get your ticket to the upcoming summit, January 17th. Time is ticking, right? It's going by quick. So if you haven't got your ticket yet, be sure and do that. We also have a mixer the night before. If you'd like to get a ticket for that as well, come hang out with us, have some hors d'oeuvres, drinks. We'll all talk and visit. It'll be a really good time. But again, all the information is on the website, realinvestmentadvice.com. Just click the link, get your ticket today. And also, while you're there, make sure you're subscribed to our newsletter, our weekly market outlooks, our daily market outlooks, and our blog posts. Those are all on the website. They're all free. We deliver them right to you. Just subscribe, put your email address in. We'll email those to you whenever we publish them. All right. Have a great day. We'll see you back here on the next edition, of the Real Investment Show.